Okay, let's talk about something that, well, holds the key to a lot of major financial doors in your life, your FICO score.
It really does. It controls whether you get approved for loans, what interest rate you'll pay on, say, a mortgage or a car loan.
Yeah, and it even factors into things like insurance rates sometimes.
Definitely. So understanding this number and, more importantly, knowing exactly how to boost it.
It's not just smart finance, is it? It
Mhm.
can literally unlock opportunities, things you might not even have thought about.
Absolutely. And for this deep dive, we're going straight to the experts, you know?
Right. We've gathered a stack of sources, guides, and articles from places like QuickCash, NerdWallet, MyFICO.
Experian, Equifax, the Consumer Financial Protection Bureau, the CFPB,
Yeah.
solid sources.
Exactly. These aren't just opinions. They lay out the proven strategies based on how the system actually works. So our mission today, cut through all the noise, all the confusion you might hear about credit,
Yeah, there's a lot of that out there.
and just extract the most important, actionable stuff straight from these materials.
Give you a clear understanding of exactly how the FICO score is put together.
And the fastest, most effective ways to improve it, based only on what these sources tell us.
Think of it as your shortcut to getting really well informed on this. It's crucial stuff.
It really is. So where do we begin this deep dive?
Well, you got to start with the foundation, right? The
Okay.
building blocks of the FICO score itself.
Okay.
It's not just some mysterious number calculated in like a black box somewhere.
All right.
According to these sources, it's a reflection of your financial habits, specifically your credit behavior.
Distilled into 5 key components, like its DNA.
I like that financial DNA. Yeah, at least as far as borrowing goes.
And each part of that DNA, it has a different weight, right? A different importance in the score.
Exactly. The sources break this down really clearly, gives us a roadmap of where to focus.
So what's the biggest piece?
The biggest piece of the pie, the single factor that matters most, is your payment history.
Payment history, how much does that count for?
A significant 35% of your score.
35%. Okay, that's huge.
Absolutely. I mean, think about it. When a lender is considering giving you money, what's their main question?
Will I get paid back? On time.
Exactly. Will they pay me back, and will they pay me back on time? Your past payment behavior is the best predictor of that.
Makes sense. If you've got a history of being reliable, paying your bills by the due date.
You're seen as much lower risk. Simple as that. But missed payments, major red flags.
Right. It's the core of credit, really. Paying on time. Okay, so that's 35%. What's next?
The next biggest piece, weighing in at a substantial 30%, is amounts owed.
Amounts owed. That's like credit utilization.
Yeah, often called your credit utilization rate. It's basically the total amount you currently owe across your revolving accounts, think credit cards, compared to your total available credit limits.
Okay.
And the sources emphasize, just having credit and using it isn't necessarily bad.
Right. It shows you can manage it.
Exactly. But if you're using a very large percentage of your available credit, if your balances are high compared to your limits.
It looks like you might be stretched thin.
Precisely. It signals to lenders that you might be financially overextended, maybe too reliant on credit. That increases their perceived risk, and that's why it carries such a heavy weight, 30%.
Got it. So having credit is fine. Using a little is good, but maxing out or using a high percentage, that's the problem. Managing those balances is clearly crucial.
Definitely.
Okay, moving on. 15% comes from length of credit history.
Length of credit history, yep. This looks at how long your credit accounts have been open and active.
How long you been in the game, basically.
Pretty much. And the sources say you don't need like decades of history for a good score,
Okay.
but a longer history is generally seen as positive. FICO looks at a few things here. The age of your oldest account, your newest account, and the average age of all your accounts.
And how long since you used them?
Yeah. They also consider how long it's been since you last used certain accounts. The idea is a longer track record, especially a good one, gives lenders more data to see if you're reliable over time.
Okay, so older is generally better. More history to look at. Got it.
Yeah.
The final 2 pieces are smaller.
Yeah. Each accounts for 10% of your score. One is your credit mix.
Credit mix. What does that mean?
Credit mix refers to the different types of credit accounts you manage. So revolving credit, like credit cards, lines of credit.
Where the balance goes up and down.
Right. And installment loans, mortgages, car loans, personal loans, student loans, loans where you borrow a fixed amount and pay it back over time with regular fixed payments.
Ah, okay. So having both types.
The sources suggest that responsibly managing a mix of these different types can positively impact your score. Shows you can handle different kinds of debt.
Interesting. And the last 10%,
That's new credit.
new credit. So like applying for cards.
This component looks at recent credit activity, how often you're applying for new credit, and how recently you've opened new accounts.
Why did that matter?
Well, the sources indicate that opening several accounts in a short time represents increased risk to lenders.
Especially if you don't have a long history already.
Exactly. It can look like you're either in urgent need of credit, maybe desperate, or potentially taking on more debt than you can really handle.
Okay, that makes sense. So let's recap that financial DNA real quick.
Sure.
Payment history is the big one, 35%.
Mm-hmm.
Amounts owed or utilization, 30%.
Right.
Length of credit history, 15%.
Yep.
And then credit mix and new credit, both at 10%.
That's the 5 pillars.
But you mentioned something earlier. The sources say there's a nuance about these percentages. They're not set in stone for everyone.
Absolutely. That's a critical point. While those percentages are the widely cited averages for, the general population, the sources make it clear the exact importance can actually vary depending on your unique credit profile.
How so?
Well, for example, if you haven't been using credit for very long, the new credit and length of history categories might have a slightly different weight for you compared to someone with, decades of credit experience.
Ah, okay. So it adapts.
Your score is dynamic. It evolves as the information in your credit report changes over time.
That makes total sense. Your personal credit journey shapes how the formula applies. And it's crucial, based on the sources, to understand where FICO gets all this info from.
Yes. Your FICO score is calculated only from the information found in your credit report.
The ones maintained by the big 3 bureaus, Experian, Equifax, TransUnion.
Precisely those 3.
So lenders might look at other stuff, right? Like income.
Exactly. Lenders might look at other factors when making a final decision. Your income, your job history, the type of loan, maybe collateral like a car or house.
But the FICO score itself, that number.
That specific 3-digit number is strictly derived only from the data points reported on your credit file, nothing else.
Understanding that is key. It tells you exactly what levers you can pull to actually influence the score.
Right.
All right, we've unpacked the DNA, the components, how they're weighted. Now let's get to the really actionable part, the proven strategies to actually elevate your score based directly on these sources.
Okay, let's dive in.
Since payment history is the biggest piece at 35%, that seems like the logical place to start our strategy deep dive.
Strategy number 1, according to basically all the sources, make on-time payments the absolute non-negotiable foundation.
The foundation.
If you do nothing else, master this. It's the single most significant factor.
Why does it matter so much?
Right.
Beyond just the 35% weighting?
Because, as we said, lenders see your past payment behavior as the most reliable indicator of your future behavior.
Will you pay them back on time?
Exactly. It's a direct signal of your risk level. A spotless payment history says you're responsible. Late payments, big red flag.
And the sources are pretty clear. Even one late payment can be bad news.
Right.
It's not a small thing.
It's absolutely not. Even a single late payment can significantly dent your score, especially if you had good credit to begin with.
Wow.
And it's crucial to understand the timeline here, as detailed in the sources. Late payments generally aren't reported to the credit bureaus.
So they don't impact your FICO score.
Right, until they're at least 30 days past the due date.
30 days?
Yeah.
Okay. But you might get fees sooner.
Oh, yeah, you might get hit with late fees from the lender much sooner, sometimes the very next day. But the negative mark on your credit report typically doesn't happen until you're a full 30 days or more late.
Okay, so there's like a grace period, a window between the due date and that 30-day mark where you can avoid the score hit, even if you pay a fee.
Exactly. If you realize you've missed a payment, the sources emphasize, pay the full amount due as quickly as possible.
Jump on it.
Yes. If you can pay that full missed amount before it hits 30 days past the original due date, it typically won't be reported as late and won't directly hurt your FICO score. That's critical info.
That is huge. But what if you do miss that 30-day mark, if it gets reported?
Well, if it is reported, meaning you were 30, 60, 90, or even more days late, that negative mark can stay on your credit report for up to 7 years.
7 years. That's a long time. Does its negative impact last that whole time?
Not necessarily with the same punch. The sources explain that while it stays on the report for 7 years, its negative impact on your score diminishes over time.
Right.
The more recent a late payment is, the more damage it does, as time passes and, crucially, as you keep making on-time payments on everything else.
Impact of that old mistake fades.
It lessens, yeah. Consistency after a stumble is really key to mitigating the long-term damage.
So what concrete actions can listeners take right now? to make sure they're hitting that 35% perfectly?
The sources offer very practical advice. First, set up auto pay.
Auto pay. For everything.
For at least the minimum amount due on all your credit accounts, credit cards, loans, everything. It's a safety net.
Don't just rely on memory.
Definitely not. Use calendar reminders, set alerts on your phone, use the online account alerts from your banks or credit card companies.
Lots of those offer email or text alerts now.
Exactly. Use every tool you have to avoid missing a payment date, and especially avoid crossing that crucial 30-day late threshold.
And there was something interesting mentioned in some sources like Experian stuff about other bills. Bills not usually on your credit report.
Yes, services like Experian Boost are mentioned. The idea is to potentially leverage positive payment history for bills that don't normally show up.
Like rent, utilities.
Eligible rent payments, utility bills, cell phone bills, things like that. If you're paying these on time consistently, Experian Boost might let you include that positive history in your Experian credit file.
So it could help your score.
It only impacts the Experian version of your report and FICO scores using that data, but yeah, it could potentially provide a boost by adding more positive payment info, especially if you have a limited credit history otherwise. It's a way to get credit for responsible stuff you're already doing.
That's pretty neat. Leveraging bills you pay anyway. Okay, let's move to strategy 2. Tackling the second biggest piece. Amounts owed, that 30% factor, credit utilization.
Right. This is all about optimizing how much of your available credit you're actually using. Like we touched on, having credit, owing some money isn't inherently bad.
Shows you're using it.
Right. But using a large percentage, that signals you might be stretched thin. Lenders see that as higher risk, hence the big 30% weight.
We've all heard that 30% rule, right?
Right.
Keep balances below 30% of your limit. Is that still the golden rule according to these sources?
The sources definitely confirm that 30% guideline is a very good target. Aim for that, especially on individual cards and overall across all your revolving accounts. Staying below 30% is generally good.
Okay.
However, they also point out something fascinating. The most credit-worthy people, the ones with the highest FICO scores, they typically average around 7% utilization.
Wow, 7%. That's way lower than 30.
Dramatically lower. So while under 30% is good, aiming significantly lower, maybe single digits, is even better for maximizing your score.
So the lower the better, basically. Is 0% best?
Well, the sources imply that while 30% is a good ceiling, getting excellent scores often means much lower utilization. And there's also a point made that having some utilization, even like 5%, might actually be slightly better than 0% on all accounts.
Why is that?
It shows active, responsible use rather than just letting the cards sit dormant. Though honestly, the benefit of very low versus 0 is much less significant than the harm of high utilization, like 50% or more. Getting under 30%, ideally under 10%, is the main goal.
How is utilization actually calculated? Like, is it my balance right this second?
That's a critical detail the sources highlight. It's your current reported balance divided by your credit limit times 100 for the percentage.
Reported balance.
The key is reported. FICO uses the limits and balances that your lenders report to the credit bureaus. And that reporting usually happens once a month.
When? Like, on the due date?
Typically around your statement closing date, not necessarily the due date.
Ah, okay. So even if I pay my card off in full today, my report might still show the higher balance for my last statement until the lender reports the new 0 balance, which could take weeks.
Precisely. The balance impacting your score isn't always what you see when you log in right now. It's the balance reported by the lender, usually at the end of the billing cycle. This lag matters.
Especially if you pay in full after the statement closes, but before the due date, the high balance might still get reported.
Exactly.
So what actions can we take to optimize this 30% or ideally 7% piece?
Well, the most impactful action is straightforward but needs discipline. Prioritize paying down high credit card balances. Get those balances down relative to your limits.
Makes sense.
The sources also mention options like debt consolidation loans or balance transfer cards as potential strategies for managing high balances.
Shifting the debt around.
Essentially, yeah. Moving higher interest revolving debt to maybe a lower interest installment loan or a card with a 0% intro APR to tackle it faster. These have their own pros and cons, of course, but they're presented as ways to deal with high utilization.
And what about managing that reported balance given the delay we talked about?
That's where timing comes in. The sources suggest a smart tactic. Try paying your credit card bill shortly before the statement closing date.
Not just before the due date.
Right. Or if you use your card a lot, make multiple smaller payments throughout the month.
Why does that help?
It helps ensure the balance that gets reported to the bureaus is as low as possible, even if you spent more earlier in the cycle.
Did you give an example?
Sure. Say your limit is $5,000. You spent $2,000 this month. That's 40% utilization. Not great. But if you pay off, say, $1,800 before the statement closes.
Then the reported balance is only $200.
Exactly.
Right.
Which is just 4% utilization, $205,000. Much, much better for your score.
That's a clever trick.
And they also mention using a card for a small purchase, like coffee, and paying it off before the statement date. Shows activity, keeps reported utilization super low.
Those are definitely concrete steps. Okay, strategy 3 accounts for 15%, nurturing your length of credit history.
Right. This factor, again, is about the age of your credit accounts. Not as heavy as payments or utilization, but a longer track record of managing credit well is generally positive.
Lenders like seeing stability over time.
Exactly. FICO looks at the age of your oldest account, your newest, the average age of all of them. And, like we said, how long since you used certain ones, because dormant accounts might get closed by the issuer eventually.
So what's a common mistake people make here with length of history?
The sources explicitly warn against closing old, unused credit accounts.
Even if you don't use the card anymore.
Yeah. It might seem logical. I don't use it. Maybe it's an old card. Let me close it. But doing that can hurt this factor.
How?
Closing an old account immediately shortens the average age of all your accounts, especially if it was your oldest one. That average age drops.
And doesn't closing an account affect utilization too?
Yes, good point. It can impact other factors. Closing an account reduces your total available credit.
Even if the balance was 0?
Yep. Its limit still counted towards your total available credit. You close it, your total available credit goes down. If your balances on other cards stay the same,
Your utilization percentage automatically goes up.
exactly. So closing an old account can potentially hurt both your length of history and your utilization ratio. Double whammy.
Wow. Okay, that makes a lot of sense. Lose the history, utilization might jump. So the action here is pretty simple. Keep old accounts open if you can.
Correct. Even if it's an old card you rarely use, the sources suggest maybe making a small purchase on it every few months.
Like gas or a coffee.
Something small. Pay it off immediately. Just keeps the account active so the lender doesn't close it for inactivity.
What if it has an annual fee I don't want to pay?
Check with the issuer. See if you can downgrade or product change to a different card, maybe one with no annual fee, while keeping the same account number and history.
So you keep the history intact, but ditch the fee.
It's often possible, worth asking about to preserve that valuable history.
That's a smart move. Okay, strategy 4 deals with another 10% factor. Being strategic with new credit.
Right. This looks at recent applications and new accounts. The research cited in the sources shows that opening several new accounts quickly looks risky.
Especially for people without a long credit track record.
Exactly. It signals increased risk to lenders.
And this relates to hard inquiries, doesn't it?
Precisely. When you formally apply for most types of new credit card, car loan, mortgage, personal loan, the lender usually pulls your credit report.
And that gets recorded.
As a hard inquiry on your report, each hard inquiry can slightly lower your score, usually not by much, maybe less than 5 points.
But if you have a bunch close together.
Multiple hard inquiries in a short time, especially for credit cards, can have a compounding negative effect. Looks like you're scrambling for credit.
So the main action here is just don't apply for credit unless you really need it.
Pretty much be intentional. Don't just apply because you got a shiny offer in the mail.
Resist the temptation.
Exactly. And the sources offer a helpful tip. Before you formally apply, see if the lender offers pre-qualification or pre-approval.
How does that help?
That process often uses a soft inquiry or soft pull. Unlike a hard inquiry, a soft pull does not impact your FICO score.
So you can check your chances without hurting your score.
Right. Pre-qualification gives you an idea if you're likely to be approved and maybe what terms you'd get without that score ding.
That's really valuable for testing the waters.
Yeah.
But what about when you're shopping for big loans, like a car or a house? You want to compare rates. Doesn't applying multiple places mean multiple hard hits?
That's a very important point the sources address,
Yeah.
and it shows how FICO tries to be smart about this.
Okay.
They explain that when you're rate shopping for installment loans, so mortgages, auto loans, student loans, newer FICO versions recognize this specific behavior.
Oh.
If you apply for the same type of installment loan with multiple lenders within a certain time frame, FICO often groups those inquiries together.
And treats them as one.
treats them as a single inquiry for scoring purposes. This shopping window varies depending on the FICO version, but the sources mention it can be anywhere from 14 days up to 45 days.
That's huge. So you can shop around for the best rate on a mortgage or a car loan without wrecking your score, as long as you do it quickly.
Exactly. Do your rate shopping within that, say, 2-week or month-long window. It lets you find the best deal without being unduly penalized. Saves you potentially thousands over the life of the loan.
That is incredibly helpful detail. It facilitates smart shopping. Okay, fifth strategy, the last 10% factor, cultivating a healthy credit mix.
Right. This considers the types of credit you manage. FICO looks at whether you have a mix of revolving credit cards and installment loans, mortgages, car loans.
And handling both well is good.
Responsibly managing both types can show lenders you can handle different forms of credit, which can positively impact your score.
But the sources said this isn't usually the most critical factor.
That's right. They note that while a diverse mix can be beneficial, it's generally not a major decider for getting approved initially, especially if your history is limited.
So it's more like fine-tuning. Takes a good score to excellent.
Often, yeah. It's not necessary to have every single type of account to have a good score.
So what's the action here? Should I, go get a small personal loan I don't need just to add an installment loan to my mix?
Absolutely not. The sources strongly caution against that. Don't take on unnecessary debt just to try and tweak your credit mix. That's counterproductive.
Okay, good. So how does it improve naturally?
Your mix will likely diversify over time anyway as your life needs change. You might get a student loan, then later a car loan, maybe eventually a mortgage.
So let it happen organically.
Mostly, yes. If you're just starting out and want to show you can handle different types, some sources mention combining a starter credit card with maybe a small credit builder loan.
What's a credit builder loan?
It's designed specifically to help build history. You borrow a small amount, the lender holds it, and you make payments over time. Once paid, you get the money. It proves you can make installment payments.
Ah, okay. So that could be a strategic tool if it fits your situation.
Right, but only if appropriate. Don't force it.
Okay, so focus on the big pieces. First, payments, utilization, and the mix will likely sort itself out, or it can be strategically built if needed. Those are the 5 pillars and strategies.
Yeah.
But the sources also offer some other tactics, right? Things that can help, especially in certain situations.
Definitely. One major one is disputing inaccurate information on your credit report.
Finding errors.
Yeah. Errors happen more often than you'd think, and they can seriously hurt your score. Especially big errors, like a payment reported late when it wasn't, or maybe a fraudulent account opened by an identity thief.
That sounds scary.
It can be. But the sources emphasize you have a legal right under the Fair Credit Reporting Act, the FCRA, to dispute information you believe is inaccurate or incomplete.
Okay, so how do you actually do that based on sources like the CFPB?
It's generally a 2-step process, and it's often best to do both steps around the same time.
Step 1.
First, dispute the info directly with the credit reporting company Experian, Equifax, or TransUnion, whichever one is showing the error.
How? Call them.
The sources recommend doing it in writing, though online disputes are usually an option too. A written letter creates a better paper trail.
What needs to go in that letter?
The sources are pretty specific. Your full contact info, any report confirmation number, clearly list each item you're disputing. Account numbers are helpful.
And explain why it's wrong.
Yes. Explain why you believe it's inaccurate or incomplete, and state clearly what you want them to do. Remove it, correct it, update the status.
What about proof?
Crucial. Include a copy of the part of your credit report showing the error, maybe highlight it, and attach copies, never originals, of any documents supporting your claim.
Like bank statements showing payment.
Account statements, canceled checks, maybe a police report if it's identity theft, anything that proves your case.
And how should you send it?
Strongly suggested. Certified mail, return receipt requested. That way you have proof they received your dispute.
Okay, that's thorough. What happens after the credit bureau gets the letter?
According to the sources, they generally have 30 days to investigate, sometimes 45 if you provide more info later.
Or they do.
They have to forward all the relevant info you sent to the company that originally provided the information. That's called the furnisher.
Like my bank or credit card company.
Exactly, or a collection agency. The furnisher then reviews it and reports back to the credit bureau.
And then the bureau tells me the results.
Yes. Once the investigation is done, the credit bureau must tell you the results and send you a free copy of your report if changes were made.
Can they just ignore it?
They can dismiss disputes, they consider frivolous maybe if you don't provide enough info, or they already investigated it, but they still have to notify you quickly if they do that.
Okay, so that's step one with the credit bureau. What's step two?
You should also dispute the error directly with the furnisher, the company that reported it in the first place.
Send them a letter too.
Yeah, send them a written dispute as well, also using certified mail. They also have a duty to investigate and usually must respond within 30 days.
Why do both?
It ensures both parties involved in reporting the error are alerted and investigating, covers your bases.
And if they find out it was wrong or can't prove it's right?
If the furnisher finds it was incorrect or if they can't verify it, they have to update or remove the information, and they must notify all the credit bureaus they reported it to.
And the bureaus update my report.
Yes. Then the credit reporting companies update your reports. Getting errors removed, especially major ones like late payments, can really boost your score, sometimes quite quickly.
What if they investigate and say, nope, it's accurate, but I still disagree?
If they determine the info is accurate, the sources say you have the right to ask the credit reporting companies to add a brief statement of your dispute to your credit file.
Like my side of the story.
Exactly. It becomes part of your report, so anyone who pulls your credit in the future sees it. It doesn't remove the item, but it adds context. And the CFPB is mentioned as a resource if you have problems with the process.
That's incredibly helpful. A clear process to follow for errors.
Mm.
Okay, another tactic discussed. Becoming an authorized user on someone else's card.
Yes, this can be useful, especially for people starting out or rebuilding credit.
How does it work again?
You get added to someone else's credit card account. You might even get a card with your name on it. But the key thing is, the primary cardholder is legally responsible for paying the bill for all charges.
So how does that help my credit?
Well, critically, it depends if the card issuer reports authorized user activity to the credit bureaus. Many do, but not all.
Okay, assuming they do report it.
Then you can potentially benefit from the primary user's good credit habits on that account, their positive payment history, their low utilization on that card that can reflect positively on your report.
Who does this help the most, according to the sources?
They highlight it's particularly helpful for folks just starting out, maybe with a thin file, not many accounts of their own.
Like young adults.
Yeah,
Or maybe immigrants new to the U.S. system.
exactly. Also, people rebuilding after past problems or those having trouble getting their own card yet. Being added to a well-managed account with a long history can potentially help you get a FICO score faster, sometimes under 6 months if you had none, and improve it by adding positive data.
What are the specific pros mentioned for the authorized user?
Well, beyond potentially inheriting a good payment history, it can really help your overall credit utilization rate.
How?
The sources give a good example. Say you have your own card, 1K limit, $300 balance, 30% utilization. Then you get added to someone's card with a $15 balance and only a $500 balance.
Okay.
Your own card is still 30% utilized, but your overall utilization calculation now includes that second card's limit and balance. Your total available credit jumps to $16,000, 1K plus 15K. Your total balance is $800, $300 plus $500. So your overall utilization plummets to about 5%, $816,000.
Wow, that's a huge drop just from being added.
It can be dramatic. Plus, usually no credit check for you to be added. Parents can sometimes use it to help kids build credit, depending on the bank's rules, and maybe it helps the primary user keep an old account active.
Well, those are big potential benefits.
Right.
But there have to be downsides, right? Risks.
Absolutely, and the sources detail them. For the primary user, the biggest risk is they're legally on the hook for all charges, even yours.
Yikes.
And for you, the authorized user, the main risk is if the primary mismanages the account, if they make late payments or run up a huge balance.
That negative stuff shows up on my report, too.
Yes, and it hurts your score even though you didn't cause it. Their utilization could surge, hurting both of you. And ultimately, lenders prefer seeing you manage your own credit responsibly.
So it's not a magic fix or long-term solution necessarily. What's the strategy for using it effectively then?
The sources suggest viewing it as a temporary boost, a stepping stone, especially if your goal is to build enough credit to get your own accounts.
So communicate clearly with the primary user.
Crucial. Have a clear, trusting agreement about usage, payments, maybe set timelines or score goals for when the arrangement ends.
And then use the improved score to get my own card.
Exactly. Use it as a springboard to apply for your own starter card or a credit builder loan. Build your own history. Just be aware when you're removed from the account that positive history might vanish from your report. So ideally, your own credit is strong enough by then.
That makes sense. Use it as a bridge. Okay, one more tool mentioned, secured credit cards, especially for people struggling to get approved for regular cards.
Yes, secured cards are highlighted as a tool designed for exactly that, people starting out or rebuilding who find it hard to get a standard unsecured card.
How do they work differently?
With a secured card, you have to provide a cash deposit when you open it.
Like collateral.
Exactly. That deposit usually equals your credit limit. So a $300 deposit means a $300 limit. The sources explain it secures the money you borrow.
So it's kind of like a debit card, using my own money.
It functions similarly in that your money reduces the lender's risk. But the critical difference, why it helps build credit, is that unlike debit cards, the secured card issuer may report your payment history and activity to the credit bureaus.
Ah, so that's how it builds credit.
If they report it, yes.
Yeah.
That reporting is what makes it a credit building tool.
And they're easier to get approved for.
Precisely. Sources note they often have more lenient approval requirements because the deposit lowers the issuer's risk, makes them accessible for folks with limited or damaged credit.
What are the main pros listed in the sources?
Accessibility is key. Plus, they can genuinely help you establish or rebuild positive credit history if used responsibly and reported. The deposit is usually refundable when you close the account in good standing.
Can you ever get it back without closing the account?
Some issuers will review your account after a period of responsible use, maybe 6-12 months, and might graduate you to an unsecured card, returning your deposit automatically.
That's great. What about the cons?
Sources point out several. Secured cards often have higher fees, annual fees are common, and potentially higher interest rates.
And the limits are low, right? Tied to the deposit.
Exactly. Limits are usually low, and that low limit makes managing utilization tricky.
How so?
Well, if you have a $300 limit, spending just $100 means your utilization is 33%, $300, already over that 30% guideline. Makes it hard to keep utilization low unless you spend very little.
And you need cash up front for the deposit.
Right. That can be a barrier for some.
So given those points, what's the strategy for using a secured card effectively?
Use it responsibly and view it as a tool, a stepping stone. The absolute main focus: make consistent on-time payments every single month. No exceptions.
And watch that utilization.
Yes. Keep utilization as low as possible, well below 30%, ideally single digits. Make frequent payments or use it sparingly.
Show good habits over time.
Exactly. Build that positive history, manage utilization well, and eventually you should qualify for better unsecured cards with higher limits and lower costs. It takes patience and discipline.
These are all really solid, actionable strategies pulled straight from these expert sources. And, a consistent theme seems to be, this isn't an overnight fix.
Absolutely. The sources all emphasize, underscore, reiterate, improving your credit score is a marathon, not a sprint.
No magic bullet.
No secret loophole, no quick fix. It takes consistent application of these strategies over time, paying on time, managing utilization, keeping old accounts open.
It adds up gradually.
It might not give you a 100-point jump tomorrow, but those consistent positive actions build on each other. They lead to gradual compounding improvements over months and years. Even small positive changes today matter long term. Patience and consistency are maybe the most important strategies of all.
Okay, wow. We have covered a ton of ground in this deep dive. We unpacked the FICO score's DNA payment history, 35%, amounts owed utilization, 30%, length of history, 15%, credit mix, 10%, new credit, 10%.
And at Tillers, yeah.
Then we walk through the proven strategies, making on-time payments non-negotiable, actively keeping utilization low, preserving old accounts, being smart about new credit, understanding credit mix, plus those extra tactics, disputing errors diligently, understanding authorized users as a potential boost, and using secured cards as a pathway if needed.
A lot of tools in the cool box.
The key lesson here, drawing from all these sources, seems to be that a good credit score isn't just some random number. It really is a reflection of your financial habits over time.
It truly is. When you understand how it works and consistently apply these strategies, you're not just improving a number, you're building a foundation.
A foundation for financial flexibility. Stability.
Flexibility, stability, control. It gives you power in the financial system. It gives you options when you need them.
It really does. And that leads to maybe a final thought for you, the listener, to consider.
Yeah.
As you take this knowledge in, think about this. How might mastering your FICO score and really mastering the responsible habits behind it, how might that open up opportunities in your life you haven't even begun to imagine yet?
Buying a home, maybe. Starting a business. Or just, peace of mind.
Something powerful to think about.
Definitely.
Well, that's all the time we have for this deep dive into boosting your FICO score fast. We really hope this detailed unpacking of the sources has given you a clear, actionable roadmap.
Yeah, a roadmap for building and maintaining a healthier score. Thanks for joining us for this deep dive into the sources. We hope it was valuable and empowering for you.
Until next time.